Stay informed on earnings trends and analysis in Zacks Earnings Outlook.
Well, we're getting ready to close the books on another earnings season, and so we brought Shiraz Mian, our research director, here to kind of put it all in perspective.
Sure.
Right, at least for the Q1 reporting season.
Yep.
So what we've seen here for Q1, many people have called excellent earnings season. But let's not forget, because you and I have talked about this at the beginning of the earnings season, when you're looking at year-over-year comparison,
That's right.
the bar was set kind of low.
Yeah.
Right? So now going forward, is the bar going to get set higher?
Yes and no. And the reason I'm saying that is that energy was the big sector where the comparisons were the easiest. So we had in the first quarter of 16 a small loss for the sector. They lost about $1.5 billion, and the sector earned about $9.5–10 billion, so a good $11–12 billion in profitability swing, which is a huge for a sector.
Mm-hmm.
But if you look outside of energy, there's been plenty of momentum in a host of other sectors, which is not a function of easy comparisons. So whether you're looking at finance, whether you're looking at technology, and some of the other sectors. So yes, there were easy comparisons, and some of that will continue for the next 2 quarters as well. The energy one in particular.
Mm-hmm.
Energy growth turned positive, you would recall, in the 4th quarter of 2016. So for the first 3 quarters of 17, we have comparisons to very low levels. But the question then is, will the momentum in technology, finance, industrials, materials, and all the others, will that continue?
Mm-hmm.
So that's
the answer to that question?
The answer is we still don't know, but the odds are that yes.
Okay. So if you had to put your finger on some things that were good in this Q1 earnings season, what are some of the good things that came out of it?
Plenty of good. And your reference to the season being excellent, I would second that. I have a couple of slides to show folks here. This compares the results we have seen already. And by the way, 458 S&P 500 companies have reported results already.
As of
this morning.
This morning, May 17th.
And so growth is tracking 13.7% for earnings, 7.7% for revenues. That's the left-hand side chart, which compares the results thus far in Q1 with what we saw from the same group of companies in the previous quarter, meaning the 4th quarter of 16,
mm-hmm.
And then the 4-quarter average and the 12-quarter average. And as you could see, it's across the board positive comparison.
Even without energy.
Even without it. We are not showing on an X-energy basis, but even on an X-energy basis, the growth picture compares favorably to what we have been seeing. On an X-energy basis, the 13.7% will become 9%.
Okay.
So it's pretty good. The right-hand side chart compares the proportion of companies that are beating estimates.
Mm-hmm.
We're used to company beating EPS estimates easily, so we don't really put a lot of stock into an above-average proportion of EPS beats.
Okay.
But look at the proportion of companies beating revenue estimates. 65.9% beating revenue estimates in Q1, which is literally off the charts, as you see in this comparison.
Mm-hmm.
And I highlight and focus a little more on this proportion of positive surprises here. What we are showing here is the 51.6% of the companies that have reported results are beating both EPS and revenue estimates. And as you could see, that's a very favorable comparison to what we have seen in the past. And then I want to mention briefly, there was stuff that happened in Q1. I want to mention as a positive of the Q1 earnings season what happened to estimates in Q2.
Okay.
And that's what we are showing in this slide. At the beginning of the quarter, in late March, we were looking for 7.9% earnings growth for the S&P 500 in Q2, which has now come down to 5.8%. Some may be surprised that I'm showing it as evidence of positive or favorable trends, but it actually is. As negative as it looks, that the trend is negative, it's actually an improvement over what we have been seeing in the comparable periods in the last couple of years, meaning estimates are coming down, but they aren't coming down as much as we have been used to over the last few years. So all in all, a pretty positive and reassuring picture that we saw coming out of this earnings season.
Not to mention the positive guidance.
Absolutely, and that's what we are seeing in this estimate revisions trend.
Yep.
The estimate revisions trend is guided by how management discussed not only the business as it was in Q1, but what they are seeing in Q2.
So give us the scorecard.
Okay, so I have the not very liked, busy-looking scorecard table here. 91.6% of the index members have reported results. That's 93.7% of the total market cap. As I mentioned, 13.7% is the earnings growth. In Q1, 7.7% is the revenue growth. 72.3% are beating EPS estimates, and 65.9% are beating revenue estimates. The last row in this scorecard shows the results on an ex-oil basis.
Okay.
So you could see that on an ex-oil basis, earnings would be up 9%, still a very good rate relative to what we have seen over the last couple of years, and revenues would be up 5.5%. So very positive growth, all around positive surprises and favorable trends in what we are seeing in estimate revisions for Q2.
So standout sectors, what were they?
So energy we mentioned
Right.
as to how big a swing for them was.
Right.
Finance did very well. Technology really stood out, double-digit earnings growth. And across the board, other than some of the recent results from retail, pretty much most of the sectors pulled their weight in the index as a whole. But technology, finance, energy, materials really stood out.
That brings us to retail. What the heck is going on? You're going to see some retail stocks on clearance here?
They are on clearance, actually.
Yeah.
The department stores in particularly, nothing new there. It's been a recurring problem. We've been seeing this every earnings season. There have been some standout positive results as well. This morning we had good numbers from Target. Home Depot the other day did better. But overall, the department store space has been under pressure and stressed out. Business has moved online. They have excess capacity. Foot traffic is down. As a result, their comp sales have consistently been down. Any department store you look at, Macy's was a good example of that. But whether it was Macy's, JCPenney, Nordstrom, Kohl's was marginally better, but on the whole, it's a sector that's facing secular issues with their business moving online, and they having to deal with bringing their capacity in balance with how demand for their brick and mortar space right now is.
Having said everything that we just talked about, still looking forward, you're looking for continued solid earnings growth?
I am. I think what we saw in Q1, which further confirmed the trends we saw in the preceding earnings season, in 2016 Q4 earnings season, gives us a lot more confidence and expectations for Q2, Q3, and beyond. As I showed earlier, the evolution of Q2 estimates, it's expected to be around 6% growth now. We know that typically the actual results come in a lot better than what these expectations are. So even if we don't get double-digit earnings growth in Q2 and Q3, we will be getting awfully close to that level.
All right. Well, thank you for that.
Sure.
We still have a little bit more to go with this Q1 season, but no big surprises really. Right?
Absolutely, yeah. It's just a few straggler tech companies and then the rest of retail.
All right,
Yep.
don't forget, throughout all of the earnings seasons, this one and those coming up, you can keep track of what is going on in between these video segments that we do with Shiraz by reading his earnings preview commentary every Monday, and then his periodic earnings outlook written commentaries, all on Zacks.com. Go to the homepage, link to them from there. With Shiraz, I'm Terry Ruffalo.